Good afternoon, everyone. I, Prachi Divedi, extend a warm welcome to all the participants and our esteemed speaker, CS Nutan Somani, in this 11th webinar of the Master Knowledge Series EEE 6.0 on the topic IPO Regulatory and Legal Landscape. The initial public offering, that is IPO, represents a defining milestone in the journey of any company. It is not merely a financial event, but a strategic step that opens the door to capital markets, enabling organizations to access wider pools of investment. By going public, companies enhance their visibility, strengthen their brand, and establish credibility in the eyes of stakeholders, investors, and regulators. An initial public offering, as defined under the SEBI ICTR Regulation 2018, refers to an offer of specified securities by an unlisted issuer to the public for subscription, including an offer for sale by existing shareholders. While traditionally perceived as a capital raising milestone, an IPO represents a far deeper structure transformation, one that fundamentally alters a company's governance architecture, accountability standards, and stakeholder expectations. An IPO should not be viewed as a culmination of a corporate growth, but rather as the beginning of governance intensive life cycle, where the principles of transparency, accountability, and investor protection assume paramount importance. In the context of India's rapidly evolving capital market ecosystem, IPOs have gained even after significance. The dynamic regulatory environment, coupled with increasing investor participation, makes it essential for corporates and professionals to understand the intricacies of the IPO process. However, the IPO process is not simply about raising funds, it is fundamentally about compliance and governance. Companies must adhere to stringent requirements under the SEBI regulations, Companies Act 2013, and other applicable laws. Disclosure standards, transparency obligations, and governance practices form the backbone of investor confidence and market integrity. Each step after drafting the prospectus to meeting listing requirements demands meticulous preparation and adherence to regulatory norms. The role of professionals, particularly company secretaries and compliance experts, becomes critical in this journey. They act as custodians of governance, ensuring that companies meet disclosure obligations, maintain board oversight, and uphold ethical standards throughout the IPO process. This webinar aims to provide participants with a comprehensive understanding of IPO ecosystem, including regulatory requirements, legal considerations, disclosure norms, and the role of professionals in facilitating smooth and compliant listings. It will also highlight contemporary challenges, practical aspects of IPO preparations, and the expanding opportunities for company secretaries and compliance professionals in this domain. For further deliberation on this important subject, we are privileged to have with us CS Nitin Somani. CS Nitin Somani is director and founder of Sunday Capital Advisors Private Limited, having rich experience over 2 decades in capital markets, investment banking, corporate and financial structuring, valuations, structuring of stock incentive plans, distribution of financial products, startups, finance, and secretarial compliances. His experience varies across a wide range of industries and has successfully undertaken various assignments. He is responsible for mentoring the team at Sunday and delivering solutions based advisory to the clients, structuring of the transactions, and to ensure smooth transition of the project. He is a fellow member of ICSI and CFV and registered valuer securities or financial assets. We welcome him as a speaker in this 11th webinar, and I am confident that the deliberations today will not only enhance our understanding but also equip us with actionable insights to contribute effectively to the deeper understanding of the topic. I encourage all the participants to actively engage in the session, share their queries, and make the most of this knowledge sharing platform. We welcome, with these words, we welcome you, sir, and look forward to an insightful and enriching session. Over to you, sir.
Thank you. Thanks for setting the stage for today's discussion. A very warm good afternoon to all the members of the Institute. It's a privilege to be sitting in front of you again and discussing on topics related to capital markets. Uh, we talk about IPOs. As rightly said, IPO is a milestone-changing journey today in the in the entire financial industry in India. Every company talking about fundraise, whether it is a SME company or a mid-sized corporate, MSME, or we talk about a large-sized corporate, or even companies which do not require cash, but they have abundance of cash flow, but they want more public participation into their ownership side to make it more governed company. So there are various reasons why companies come out with an IPO. We will be touching some of the outer portions with regard to the IPO process, the compliances, what are the key challenges in some of the aspects, because 2 hours is a very limited window in terms of discussion onto such a elaborative topic. But we have tried to cover up and touch few points into it. So quickly going through it, uh, firstly, we'll talk about the fundraising options. Uh, as a corporate, we have multiple options. IPO is not the only option available. You have to assess your company and decide and determine that what kind of fund your company requires. It can be promoters' own funding. It can be crowdfunding. Promoter knows 10, 20 different people. He can take small investment from all of them, which generally is called as friends and relatives money. It can be an angel investment, which is pre-series investment. It can be a business incubator, which is more in terms of technology-oriented companies where there are multiple incubation centers spread across India. And you can go to that incubation center, you get some mentoring support, infra support from there, and you share a part of your equity with them. Then comes the venture capital or the PE funding, and obviously the third party funding also comes in form of bank loans. Each company have to check based on the stage where they are, what kind of capital they require, because it is not that equity, once you have taken as a company, you don't have any obligation towards the investor. In a bank loan, you have to pay interest, but equity is much more costlier capital. On bank loan, you give an interest of 9, 10, or 11%. You get a tax shield also while doing your income tax calculation. However, on equity, you first pay 30, 25, or 30% corporate tax on the profit, and then the remaining is distributed to the investors, which is again taxable. So there is a double layer of taxation. That is the reason why equity is called as the costliest capital. Then coming to various fundraising options, if we talk about the domestic markets and the international markets. Into domestic markets, you can go with IPO or FPO. If you are already a listed company, you can go ahead with a rights issue, preferential allotment, or allotment of hybrid instruments. When we talk about international market, there can be a private investments in form of an FDI. You can also raise FCCBs or ADR, GDR, or you can always have external commercial borrowings also. When we talk about IPO, it can be done in two forms, where fresh issuance of capital take place, and another is where offer for sale happen. That means an existing shareholder sells their shares in the market. As I said in the beginning, that some companies are there which are cash rich, which are generating huge cash, but either to make it more professionally governed or to increase the public participation, or being an institution, say for example, NSE is recently coming out with an IPO. So NSE do not require cash because they are already cash surpluses. But there are 1 lakh plus shareholders who are invested in NSE today. A listing provides a equitable trading platform to all these investors where investors can deal in a transparent manner. So there are different reasons to why an IPO is being undertaken. What is an IPO? IPO is a process where you convert your company from privately held to publicly held. And why you go for an IPO? Because you may be requiring fresh capital for the growth of the company. There are various capex requirements for every company. Some companies may have already done the capex, or they get a new order book on based on which they need to expand, and they have the requirement of working capital. Certain times you need capital for your intangible asset development and future R&D also. Certain companies require capital for their marketing purpose to strengthen their distribution channel when we talk about a retail oriented company. So objective can be different, but the ultimate use of funds have to go for the development of the company's business. Then there can be long-term strategic objectives. For example, there is an NBFC. NBFC can leverage up to 7 times of their net worth, but there is always a limitation to the debt also. So ultimately, they need to create a long-term equity capital base also. Then enhancing the corporate structure. Uh, in India, you all know that there are around 13, 14 lakh plus companies. Identifying a company in this entire bucket of 13 or 14 lakh, and on the other hand, there are 6,000, 7,000 listed companies. Identifying a company into 7,000 is relatively easier. So, where you want to position your company, then increase visibility and prestige. For some of the businesses where they work with MNC, MNC certain times have restriction that for expanding your business beyond Indian land borders, you need to be listed. So there can be such kind of conditions also. And being listed, you can always reward your employees and team members if you are a business of owner and make them participate in the wealth creation. Now, whether to go for an IPO or not, it is a leap of faith. When the promoter decides onto this, promoter needs a complete handholding in terms of why they want to go for an IPO, what is the advantages, what is the disadvantages, what are the additional compliance burdens. Even you need to educate promoter that what will happen if they miss a compliance, what kind of penalties or repercussions are there. Because governance is becoming the core for each and every listed company today. And regulators, mind my word, they are absolutely not giving any leeway on the governance failure. So governance has become more and more important. Secondly, the transparency has increased a lot in the past few years because of the digitization and advent of AI and multiple other digital channels. So the information access flows very fast. So you have to be on your toes every time once you get listed. You cannot miss a compliance. Then it is not just a one-time financial transaction. It is a milestone for transformation. Today, you are might be raising a 400 or 500 crore of capital from the market, but after 3 years, 4 years, there will be more requirement of capital once you grow in size. So you have to again and again come to the market to tap fresh capital. Then, with the limitation of own sources and negative impacts of over leveraging, a promoter will always look for raising of capital through IPO. Then in emerging markets, successful and dynamic firms look to financial market as source of investments. We always talk about how many FDI inflows have come or FDI is moving out of the country from the stock market, 3,000, 4,000, 10,000 crore values moving every day in and out. So there is a huge potential of capital overseas. And capital market is a easy access route for getting that capital in India for development. Then private equity placements and IPOs are popular route to raise capital, and where the market look promising, the companies that are fully prepared are the in the best position to use that opportunity to come out with an IPO. So compliance is not a one-time function for the IPO, whether you are unlisted, whether you are planning for listing, or whether you are listed. Compliance has to continue in continuity so that you are always ready for the investors. We have discussed this briefly. What are the positives and negatives? In terms of positives, it is an easy access to capital market. There is flexibility for capital raising opportunities for business. You can always raise capital through private placement once listed. You can do a rights issue. You can do a QIP allotment. Then independent valuation of the company is undertaken and wealth is created for all the stakeholders. Once your company is listed, there is an independent market wherein buyers and sellers are available, and based on the demand, the expectation, the future growth of the company, the price is determined. For certain large companies, it also acts as an exit strategy for the private equity or venture capitalist investor and provides liquidity to shareholders. IPO brings in transparency into the system and the processes are created. Then it enhances the ability to attract, retain, and reward employees with stock incentive plans. You will see a lot of companies which are coming out with an IPO. They also float a ESOP scheme to incentivize the employees. And there is a cost associated, but it is comparatively a lower cost for the compliance. Either you get listed on one exchange or you get listed on multiple exchange. The negatives of an IPO are that this is a complete time consuming and exhausting exercise. The volume of documents which need to for due diligence, the papers which have to be created during the process, whether these are the agreements with the intermediaries, these are the business related MIS report, these are the disclosure related backup documents. All these have to be created. A data room has to be created. The intermediaries have to be provided this information. Any due diligence for mainboard bound company, generally 4 to 6 months or 7 months for completion of the entire process. Then disclosure of company information goes into public domain, so promoters have to be ready with this thought process. Then equity, as discussed, is a high cost of funding as compared to the debt funding. You lose the entrepreneurship control because public will also become shareholders in the company to the extent of minimum 25%. Then there is always a peer pressure on performance. If you get listed, for example, Zomato is listed today and Swiggy comes out with listing, or Lepto comes out with listing, or any other such kind of similar company comes out with listing. Every company will be evaluated in a comparative manner. So your performance have to be up to the mark, and if there is a change in performance, then it should be substantiated with the reasons why there is a change in performance. Then the cost of maintaining listing and compliances will increase, although that's a negligible cost compared to the overall value unlocking, but this will happen. The right way is that if you do a advanced planning and there is a long-term visibility, you can convert all these negatives slowly into positive by identification of risk and seamlessly take your company through the IPO process. Now, the first and foremost thing what comes is that your entire corporate record, which we generally say putting the house in order, should be there. These are broader head points which we have identified where you have to work as a compliance officer of the company, where ultimately your name goes on the top of the document as a compliance officer, even before the promoter. So the burden which regulator has put on the shoulders of a company secretary is much larger than we think. So we have to work on all domains where a company is working, be it the corporate, secretarial, capital related, be it the management related data, the board of directors, composition committees, be it the compliances with all applicable laws and registrations. Some of the company secretaries also share the shared responsibility for legal department. Some of the CS shares responsibility or additional role of CHRO. Certain times they also have the additional financial related role. So ultimately, you have to go onto the financial side also. You have to understand the balance sheets. All the data for last 3 year filings at least have to be put together at a particular data drive. Then the reasons of changes, whether there have been internal controls in the company, if there are any audit qualifications, that should be addressed. Then you have to assess the peer set and competition, that who are the competitors of your business, how you are as compared to your competitor. Then you have to develop processes from perspective of listing. For example, you need to have multiple policies, be it materiality policy, litigation related disclosure, your insider trading policy, internal controls. All these policies have to be created. Then you have to evaluate alternative option timelines and cost also if the funds are required. Certain of the KMP position may not be there when you are a small size of company operating, but once you go for an IPO, you have to fill up these KMP positions. Then you have to revisit the business plan and model. And last issue which comes in on the promoter side, which is consideration of the ownership issues, succession planning and taxation. So it might be possible today the promoters are holding shares in a fragmented manner within the family. But you have to look at from a perspective of 10, 20 or 30 years down the line when next generation comes into business, how the ownership should move in future, how the continuity of the business should work, which we generally call business continuity plan, BCP. Then there are certain promoter families which are already large. They enter into succession planning by way of establishment of a trust. The trust is given the shares of the company, and the trust is generally a private trust which is discretionary, and the allocation of benefits is decided in the deed. So these kind of things have to be taken care of. Then there are taxation issues also if you want to transfer the shares from one promoter group shareholder to another. I'll give you an example for this. Why it is critical? Uh, you have to identify a promoter while going for an IPO. Promoter means a person who is defined as promoter in the ROC filings or the memorandum or any IPO document. Second, there are certain directives which have been given by the regulator. So regulator said that, say if Mr. A is a promoter of the company and his wife is a director on the company with zero shareholding, then also the wife will be deemed to be promoter. If Mr. A is on the board, his wife is not on the board but holds 12% of the equity, anything more than 10%, then again wife will be considered a promoter. Now, why the term promoter is significant? Promoter term is significant because you have to go to the relatives of the promoter also who form part of the promoter group. So, promoter Mr. A, wife, wife's brother, siblings, they will also form part of your promoter group. The companies in which they own 20% or more, they will also form part of the promoter group. So the promoter group will expand in a much larger way. So you have to assess that what kind of promoter setup you need. So all these things comes under ownership issue which need to be taken care of. Now, when should you tap the market? Broadly, I understand there should be five broader parameters which should be assessed. One, what are your macro factors and capital market conditions? 2 months, 3 months before, there was an international event going on in terms of unrest in Middle East. The capital markets were not good. Investors were not ready to put in money into new equity options. So these are certain bad times. So you need to identify that what are the macro factors and international level events are happening. Second is the valuation of the company. Is that the right way you have calculated the valuation? And is it the right time to encash that valuation? Third, company readiness. How you are prepared in terms of all compliances, diligences, your documents, whether these are available or not, how your board is structured, everything will have to be decided. Fourth is competing equity pipeline. So, for example, NSE is planning to come out with an IPO, Geo is planning to come out with an IPO. These are multi-crore value IPO sizes. Now, if you open your small IPO of 200, 300, 400 crore alongside this IPO, it will be very difficult for you to get the subscription. So you have to analyze that what is the competitive pipeline during that period. Say, for example, there are two equity IPOs coming from the similar business segment. Now, that similar business segment, people will always evaluate both the companies, and whichever is felt as a better company will get more attraction. So, whether you want to get and tap the market at that time or not, it is a decision to be taken. And then investor appetite, how the investors and when the investors are very aggressively putting money into the IPO. Now, coming to broadly, what kind of listings you can have? One is a main board IPO, second is the SME IPO. Although the presentation is focused towards main board IPO, but I've just drawn a comparative analysis in terms of what the difference is. The major difference is that SME you get listed only on one exchange. Main board you can get listed on both the exchanges. SME, the approval is given by the stock exchange. In main boards, observations are given by the SEBI and exchange also gives the approval. Then into main board, there is a minimum paid up capital requirement of 10 crore. However, SME has a maximum capping of 25 crore. In main board, the minimum application size is 10,000 to 15,000 rupees, whereas in SME, the minimum application size is 2 lakh rupees. The minimum bid lot also based on the issue price. It can be 40 shares, 80 shares, 160 shares, 200 shares. So bid lot is decided accordingly. Whereas in main board, you have just one share bid size. Then minimum number of shareholders is also there. Then track record requirement is there in SME. In main board, if you do not have a track record, you can still come out with an IPO through compulsory book build. And there is a lower lock-in period for the promoters equity and the pre-IPO equity in main board for 18 and 6 months. However, in SME IPO, it is 36 and 12 months. Now, what are the eligibility criteria for a main board listing? Regulation 6.1 and 6.2, these are the two governing regulations. Regulation 6.1, it lists out the condition, which is net tangible asset of at least 3 crore should be there, and not more than 50% of that should be into monetary assets, which means bank balances. If it is assigned to a specific project, then you can have an exception over there. But otherwise, not more than 50% money should be in liquid form. Second, there should be average operating profit before tax of 15 crore in three preceding financial years, which means a total of 45 crore. It always, this particular regulation talks about average of 15 crore. So in one year, you can have 45 to 40 crore. In another year, you can have 5 crore. In third year, you can have zero. This again takes to 45, which gives an average of 15. So you comply with the condition. And third is net worth out of at least 1 crore rupees in each of the three preceding years. So if these three conditions are met, you are eligible under Regulation 6(1). But as I said, if these conditions are not met with, you do not have a track record, a 3-year balance sheet, then you fall into Regulation 6(2), which is a compulsory book building issue. Into compulsory book building, 75% of the issue size is allocated to QIBs, and the issue will fail if the QIB investment do not come into the issue. Just to give you a sense of bifurcation, how 6(1) and 6(2) allocation is done between the investors. If you see into 6(2), which is compulsory book building, institution is not less than 75. However, in 6(1), it says QIB is not more than 50. Same way for non-institutional, in compulsory, it is not more than 15%. In optional book build, it is not less than 15%. And retail category is smaller in case of compulsory book building of up to 10%. And in case of optional book building, it is 35%. You can always come out with a fixed price issue also if you are complying with Regulation 6(1). Into fixed price issue, you have to allocate 50% to retail investors and 50% to other investors. But in last multiple years, there have been no fixed price issue onto the main board category. One more point to note over here, if there is a shortfall in the QIB category, you cannot adjust the retail and non-institutional into QIB. However, if there is a shortfall in retail and non-institution, QIB gets oversubscribed. There can be a spillover of the additional oversubscription received. So that is a one-way traffic which is allowed. Now in the QIB category, again there is a bifurcation. Of the QIB category, 60% can be allocated as anchor investor. Anchor investor is an investor which comes one day prior to the IPO. They put in hard cash money one day prior to the IPO in a separate bank account, and they get the allocation on the same day. However, their allotment and release of balance funds happens along with the other IPO applicants. Then of this 160%, one third can be reserved for mutual funds. Uh, the allocation can be higher or lower also depending on the demand received by the merchant banker. And anchor has to open one day prior to the opening of the offer. The definitions of all these three categories are: retail individual investors means individuals in HUF plus their application size is less than 2 lakh. QIB investors, it is defined under the ICDR regulation. It includes bank, mutual fund, insurance companies, FII, FPIs, AIF, venture funds, 25 crore plus corpus, PF funds. So these kind of categories are defined. And any investor which is other than retail and QIB, they fall into non-institutional investor. That means non-institutional investor will always have a minimum check writing requirement of 2 lakh rupees plus. Now, the entire IPO journey, if we talk about, it can be fragmented into 4 pointers, 6 pointers, 8 pointers, but broadly it covers that you have to assess where you stand today. You have to plan for the IPO. You have to prepare and start working on the IPO side. You have to appoint the intermediaries. You have to strengthen your system, policies. Then the due diligence start by the merchant banker and the lawyers involved into the transaction. Once the documentation is completed, then you have to file for regulatory approvals, which are predominantly SEBI approval observations and exchange in principle approvals. Once you have the approval or near to the receipt of approval, you can always start the soft roadshows. You can meet with the institution, build the confidence for the shares of the company, explain them the business. There are certain plant visits also which are conducted. After that, once you have the commitment from the investor, then you go for the final launch of the IPO. You get the subscription, complete the IPO process, allotment, and get listed on the exchange. What are the benefits or the strategic outcomes of an IPO? This kind of fundraise gives you expansion financing, the capital which you require for the future expansion of the business, be it the capex, be it working capital, be it expenditure required for marketing, or be it capital required for R&D or intangible development. It strengthens the balance sheet of the company. So your fund borrowing capacity from the banks also increases once your net worth increases post the IPO. You will be ready for future fundraising because once you are listed, in unlisted you can always afford to do a late filing, or there can be certain gap because the company was old working as an unlisted and the professional was not there to manage those compliances. So there can be the various gaps into the compliances. But once you get listed, you cannot afford these non-compliances. You have to always ready with your and complete with your compliance. Then enhance market credibility. People in the market know that you are listed and what kind of operations you are doing. Institutionalization and governance. Once a anchor investor or QIB investor comes into your company, they do a deep dive into your financials. They understand more about your business because of AIF or a venture capital fund or a mutual fund. They invest in multiple companies. They know the entire investment domain much more better than your company. So institutionalization will always help to diversify and broaden the perspective of the management in terms of their business operations. Enlarge your shareholders' liquidity and value realization. Where as a shareholder, you can always sell your holding and earn money, take that money home and use that money for different other purposes or reinvest into another company. Now, the success for IPO is very simple. You have to assess, you have to plan, you have to execute, and you have to sustain in future. There is no other shortcut to it. Now, how you identify whether the company is ready or not? You have to evaluate the business plan of the company. What is your top line? What is your business pipeline for future? Then what kind of operations you are running, whether there is a scope of expansion or diversification. Can you do a backward integration or a forward integration? All these things have to assess under the business plan. With this, you have to create your projections also. Each kind of business, what you are undertaking or what you propose to undertake, what is the future outlook of that? What kind of growth you can get into that business? What kind of expenses will be there? What kind of margins will be created out of it? So entire business plan and projections have to be created. Then what kind of growth opportunities are there for the company and the industry also as a whole? Today, if we talk about, there are few industries which get a lot of attraction from the investor. For example, anything related to AI or tech, anything related to defense or railways, anything related to space technologies. These are getting a lot of investment. We all know what SpaceX have done in US after listing. It has created more than, I think, 1400 millionaires in a single day. So these kind of opportunities, whether they exist in the industry or not, then implementing best practices and the business processes. As an unlisted company, you can afford not to have controlled processes for every function of the organization. But once you go for listing, you need to have processes to control operations of each and every business function. Why? At every quarter end, you have to give results within 45 days. At every year end, you have to give audited results within 60 days. Being an unlisted company, you have the flexibility and the benefit of giving results for March till September in your AGM. But being a listed company, you have to work aggressively. You have to collect all data. Then you have to work on your investor relations. Once you work on investor relation quarterly, you have to give the presentation to your investors. In these presentations, these kind of numbers will be captured, which are coming from your internal MISs. So that's why the process have to be created, and these process have to be very robust so that whatever business change happens, you can integrate these processes with the new business verticals, or you can change these process accordingly based on the new business added to your company. Then financial reporting and budgeting tool, because you have to work on improvement of your profits. You have to work on cutting down your cost. You have to work on reporting within 45 days of the end of the quarter. So you have to put emphasis over there. Then realignment of accounting policies and standards. Uh, To quote an example, certain times when we go for IPO to assess a company, we find that the companies are not complying with some of the accounting policies. For example, gratuity accounting. So companies do not have gratuity accounting. They are not following accounting standard 14, if I am talking about Indian GAAP. So this gratuity accounting had to be put in place. But what happens? If you are filing the offer document based on March 31, 2026 numbers, you have created gratuity provision in March 26. But ultimately, for the purpose of IPO, you have to restate. You have to assume that the gratuity provision was started from day one, from the first employee which is still in the organization. So accordingly, you have to work out. Then every year gratuity hit has to be calculated. So for example, in March 26, your cumulative hit was coming as 1 crore. So March 26 will not contain that 1 crore hit. March 26 will have say 10, 20 or 30 lakh rupees. March 25 will have an X number. March 24 will have a Y number. And the remaining will be adjusted on the opening reserves and surplus. So this is how the restatement is being done. Similarly, there can be restatement for changes in depreciation policy also, either reassessment of a life of a particular asset or reassessment or change of policy from WDV to SLM method or vice versa. So these changes have to be accounted for. Then there will be respective differences on the deferred tax calculation also. So there are multiple aspects to it when we talk about accounting policy and standards realignment. This is one. Second, today when you go for mainboard IPO, your accounts have to be on Indias. Now, being an unlisted company, say your net worth was say 100 crore or 150 crore, you were not mandatorily required to do accounting on Indias. You were following Indian GAAP. So this Indian GAAP transition to Indias, this will also need to be done because restated will be prepared on Indian basis. So ultimately, you have to recreate the financial for last 3 financial years and the opening financial for the earlier third financial year. So all these accounting restatements will have to be done. Then come the investment rationale and protection for future investors to create wealth. You would have to put your investor protection policies, grievance mechanisms. Then what are the competitors, how they are operating in the market, what kind of revenue ratios and results they are giving. Then consolidation of business in different structures. Certain time being an unlisted company, you work into multiple companies. You have to consolidate all these companies together, either by way of a holding subsidiary or by way of a merger. Because once you go for an IPO, investors do not like to have related party transaction because related party transaction is the first and foremost area from where revenue leakage happens or the profit leakage happens. So ultimately, you have to consolidate your businesses into a single unified structure. Some of the investors also want that whatever business the promoter is doing, it should be done into a same company or same channel, same hierarchy. So the company, it can have a wholly owned subsidiary which is doing the other business. So these are requirements of certain specific investors. So accordingly, you have to restructure the entire group. Then secondly, there cannot be any competing activity. For example, you are having a platform, e-commerce platform into one company, and you are having a similar e-commerce platform for say a particular industry, say garments, into other company. You cannot run both business parallelly. You have to consolidate it. Then only you will get the regulatory approvals and the investor commitment. Then promoters, estate planning or holding structure. We have discussed this. Now talking about the markets. Are the markets ready? Is this the right time to hit the market? What are the sentiments of the market? What are the economic factors in India? The industry, how it is operating? What is the investor appetite and behavior at that time? What are the international macro factors? All these have to be considered. Then not just the market on one day, but you have to understand the movement of the market. So for the last 3 months, 4 months, the markets are a little subdued in terms of fresh fundraising. There are lesser number of IPOs which are coming. But is it going to continue for long? That is the decision where you have to come to an answer. If the answer is yes, you may have to hold on to your IPO opening. But if the answer is no, and you see a change in the happening in the market, a change in the investor sentiments happening, so you can always come out with an IPO. And then assessment of market appetite has to be done. I think that we have more or less covered in the previous slide also. Now, while going for an IPO, you have to first create a vision for the organization that what you are planning to do after 5 years, after 10 years, after 20 years. What is the growth path you are showcasing to the investor? And what are the strategies by way of which you are going to achieve that growth path? So this is required to be defined. Then estimation of the future projections and assessment of financial projections have to be done. These should be more rational and reasonable rather than showcasing a rosy picture to the investors and then failing on the commitments later on. And then time is an essence for coming out with an IPO. You have to absolutely, you cannot time the market, but you have to be ready to hit the market. Then there are various gaps in an unlisted organization when you work in terms of policy, disclosures, or compliances. All these gaps need to be bridged in. For example, you have certain non-compliances under Companies Act. You file for adjudication application for that before going for an IPO. For example, there can be certain loose ends on the internal controls. Whether you have plugged those loose ends on the internal control or not, all these things have to be considered. Then assess the fair market value and the fund requirement. Uh, these two terms are very synonymous to each other, but have very vast differences in terms of meaning. One is value, another is price. Value is what you perceive as a value for that company, and price is what anyone is willing to pay for that. So, for example, there are various investment holding companies. If you see these holding companies, and you replace the investment value with the market value of the investments, the prices would be much higher. But what happens? The investor looks at the value. They believe that since this is a holding company and this is a layer of investment between the ultimate investor and the ultimate operating company, there is a lack of control which the investor can exercise directly in the operating company. So they will be giving a lower price to that company. The value will be higher, but the price will be lower. So this assessment have to be done that what is the right balance between value and price. Now, when we talk about planning for an IPO, uh, I can say it is a 12 months exercise. Someone can say it is a 24 months exercise also. It depends that how large your organization is, how better governed your organization is, and what kind of documentation you keep in your routine business operations. Ideally, 12, 13, 14, 15 months is the ideal time frame for taking any company to an IPO. So during the first and foremost period of 8 to 12 months before the IPO, uh, as a merchant banker, as a lawyer, as a company secretary of the company, as a PCS handling the secretarial operations, as an auditor handling the audit function, or as an advisor to the company in normal capacity. You have to work 8 to 12 months before. You need to have a clear rationale for going to the public. It's not just that IPO comes, you get listed and you get a rosy feeling and a good feeling that you are listed now. It does not work that way. You need a rationale that why you are going to public, what you will do with that money, because that money comes with a huge onus and fiduciary capacity. So be clear onto that. Then there have to be multiple meetings with the management, the KMP, and the internal team between internal team of the advisors. Uh, Multiple aspects have to be discussed that what kind of fundraise is required, why the funding is required, where the money will be put into operations, then what kind of board structure you want. All these things are discussed at multiple meetings. Then setting the business plan and reach the targets. As I was saying that for some companies it is a 24-month exercise because before 24 months they define their targets and the financial targets. And for the next 12 months they monitor that whether they have met these targets or not. This helps you to improvise your valuations in the market. Then improvisation in the internal controls, reporting practice, and business information systems, whether you have controls also or not, whether you are taking an internal audit report or not, whether you have appointed a third party internal auditor or any employee of the company have been given the profile of the internal auditor. All these things have to be checked. Then there are certain qualifications in the audit report. Then there are certain red flags in the CARO report or the IFC report of the auditor. All those things have to be mitigated upfront. You cannot go to public with these qualifications or adverse remarks lying in the report. Then you have to be compliant with all applicable laws and obtain registrations. Small things are there. For example, you have a factory or a warehouse or godown. You do not have a fire NOC. You are having a DG set. The approval for the DG set has expired. You have certain weights and measures equipment in your factory, but you have not taken an annual appraisal or annual verification of these instruments. So these are small things which needs your attention and which need to be rectified before you go for an IPO, because these will be red flags which will otherwise come in the legal due diligence. Then what are the alternate options for raising of funds? What are the timelines and costs involved? Then you have to develop process from the perspective of listing, that once you get listed, how your company will operate, what would be the hierarchy. After that, what is the corporate and capital restructuring required? Is there requirement of any merger? Merger, if you go to NCLT, it will minimum to minimum for an unlisted company takes around 6 months. If it is going through an RD route, you will have some benefit of time available with you, but this has to be decided upfront. Then capital restructuring is also required. We'll come to that point later in this presentation. There can be group restructuring in terms of conflict of business interest between two promoter group companies, how to address that, signing into a non-compete agreement. Again, for non-compete agreement, I'll give you an example. There is a difference of opinion. Certain companies sign this non-compete agreement with zero consideration. However, certain of the professionals have an opinion that zero consideration agreement is not valid. So you have to put a consideration to it. So these kind of issues have to be addressed while you do the drafting of the legal agreement also. Then consideration of ownership issue, succession planning and taxation on the promoter's holding. Then once you are through with this, you come to the hardcore diligence side and working on the documentation. So before or simultaneous to the appointment of the intermediaries, you have to work on consolidation of all information related to company, create a virtual data room, put all the documents into that virtual data room as per the requirement of the merchant banker and the checklist given. It has to be section wise segregated. All documents have to be put into that VDR. After that, you have to start working on broad basing the board. You cannot approve a DRHP on 17th of June and appoint independent directors on 16th of June. You need independent directors to come onto the board of the company, understand the business, and then analyze what kind of disclosures are going in the document. So there have to be a considerable gap between these timings also. Then you have to appoint the KMPs, finalize the compensation. If these compensations are not adequate as per the listed company norms or acceptable in the industry, can that be bridged with a stock incentive plan or ESOP plan? Then assessment of the peer set and competition, who your competitors are, how you compare yourself with another company. So if you are a 200 crore turnover IT services company, you cannot compare yourself with Infosys, Wipro or TCS. You need to identify what kind of companies are working in that domain. Second example can be if you are working into IT domain, but you are specific to a telecom industry, then you have to see which competitor have majority of their revenue from telecom. So that will help you to assess a valuation in a much more better way by identifying the right peer. Then come brand building and creating visibility. Do you need to do a corporate advertising? Do you need to do some kind of media publicity to uh, take your name to the public? Then creating the restated financial statements, which is again a 2 to 3 months exercise, which include conversion from Indian GAAP to India's also, and introduction with the intermediaries for the IPO. Now, once the intermediaries are there, the virtual data room is complete. Then the intermediaries start the diligence process. What kind of intermediaries are required? We will again go through a different slide into it. The intermediaries, predominantly the merchant banker and lawyers, will go through the due diligence. The merchant bankers have to give the due diligence certificate while filing with the regulator. Apart from that, all other intermediaries work simultaneously with them under the role of the merchant banker. Then they have to, can be certain pre-IPO initial meetings with the institutional investor. Uh, if you have a provision for pre-IPO in the offer document, Then you can start the initial roadshow, meet with investors. Investors can be mutual fund, banks, insurance company, venture funds, AIF, FPIs. Then you have to start the brand and continue with your brand building and visibility creation exercise also. And then hold internal organization meeting to review the targets which have been given, to review the process, to review the documentation, till what level the disclosures have been made, if there any additional requirement of changes in the disclosure, uh, uh, educating the employees about the prohibition of insider trading regulations or other regulation post listing. For example, company works in a business where they on regular basis get tenders and order through tenders. Any order received, if it is material to the operations of the company, within 24 hours, the disclosure has to go. So you cannot leave aside your business team outside this entire domain. Your business team owner should know that every received order tender, every signed MOU, every executed agreement with the customer will may have to be reported with the stock exchange post listing. So that integration and education of the entire team is very much required. Then we go for the final leg, which is the launch of the IPO, where you file the offer document with the stock exchange, you get the approvals, you get the SEBI observations, then you work on the final roadshow, press broker meet, you meet with the institution investors, the advertisement have to come, the offer will open, close, price have to be determined. Today, if you see the advertisement for the price band, that runs into 3 to 4 pages, full pages of newspaper. So there are certain disclosure norms, requirements which have to be complied with. So you don't have to be just dependent on the lawyers or the merchant banker to advise on the advertisement format. You can yourself go through them, analyze whether the disclosures are right or not, because ultimately you are working as a compliance officer of the company. Uh, in a nutshell, pre-IPO SEBI filing, you have to put your house in order, engage all intermediaries, and complete the due diligence process. Once you do the SEBI filing, you have to get the in-principle approval from exchanges and observation from SEBI, and you can do pre-IPO marketing meeting. And finally, post-SEBI observation, you launch the offer, meet the investors, and agreements say with escrow bankers, syndicate members, underwriters, and then post-issue activities have to be completed. These are few benefits of listing which we have discussed. This is the simple mantra for being a successfully listed company. You identify your mission, you move toward the target, you achieve it, and you repeat this circle. This is the vicious circle where you will land up your company into. But this has to be met with so that the institution investors continue with the company for a longer period and remain invested. Now, post IPO impact on the organization. What things have to be complied with? So one, changes in the organization structure. It will be a complete change in the organization, the structure, the hierarchy. Today, as a CS, you may be reporting to a CFO or you may be reporting to one particular executive director. Post IPO, the role will completely change. There will be independent directors who will be sitting on the board. You need to interact with the independent directors also very frequently, get them engaged, keep passing on information related to the company, then establishing corporate structure and governance practices. Then you have to constitute various committees and policies. The required committees are audit committee, nomination remuneration committee, and the stakeholders committee. For example, if you fall under top 1,000 listed companies by way of market cap, then you need to have a risk management committee also. For the IPO, you can always create a IPO committee. Then there can be small committees also, which are either sub-function of board or other committees. For example, POSH committee can be there. Then there can be a committee which take care of the allotment in the routine process. So these kind of, or management committee, these kind of committees are add-on committees. Then creating transparent structure in terms of operations within the organization so that information flow is completely independent and transparent. Hiring right kind of people suitable for the key profiles, whether be it the business side, compliance side, or your legal side. The right persons have to be given charge of the business divisions, building your business and financial process and infrastructure, Then periodic event-based and strict compliance and disclosure requirements. That comes in forms of Regulation 29 disclosure and Part A of Schedule 5 of ICDR and few other disclosure requirements or Regulation 42 for your record date. So all the disclosures have to be complied with absolutely within time frame. Today, any delayed disclosure directly lands your company into SOP fine being levied by stock exchange. So SOP fines may vary from 1,000 rupee to 5,000 rupees per day or even a one-time penalty. But these kind of penalties, if levied, will have multiple repercussions. You have to put it into your governance report. You have to update your independent directors and audit committee about such kind of penalties, why it was levied. You have to give clarification to the stock exchanges also. And then the number of defaults or the value of penalties may also agitate investors asking multiple questions onto it. So all compliances have to be absolutely on time and in a proper manner. And continuous review of the business model and forecast, because on quarterly basis you have to do your investor relation exercise also. So IRPR will require all such kind of forecast to be provided. Related party transactions need higher governance and approvals, although we suggest that related party transactions should be absolutely avoided unless and until the situation warrants so. Otherwise, you should do third party transactions that more favorable from the investor's outlook. Then insider trading compliances and restriction on dealings. You need to educate your entire team on insider trading compliances. Every quarter end, there will be a trading window closure. That trading window closure, employees should know that what is the window closure, what are the relatives of employees and the relations of employees which cannot deal into shares of the company should be worked out. So this education and training in the internal team can always be done at a periodic interval, say 6 months, a year, or 15-month time period, so that even the new team members who are joining the organization, they are very well aware of this. Then attracting the right investors and analysts in continued communication with them. So it does not happen that when the IPO comes, Kotak, Birla, Reliance, Nippon, or ABC mutual fund has put money in your company and they will continue with the company forever. No, they will invest in your company. These mutual funds are working for their investors. They have to increase the wealth of their investors. So the moment they want to book profits into your company, they will sell your shares and move out. While they're selling the shares, there can be new investors who have a positive view on your company. So these new investors will come into the company. So this exercise will continue forever. For example, you will want to raise private equity or preferential allotment after the listing. So you need again a meeting with the investors. So these interactions with the investors, identifying the investor and developing their interest for remaining invested into the company. This has to be done on regular basis. Then cost involved in the fundraising through IPO is always higher compared to a loan. For example, a loan funding can always happen, a 400 or 500 crore loan can always happen at a cost of say 2%, 1.5%, 1%. Again, the cost gets spread out over the entire period of loan tenure, so the all-inclusive cost is little lower. But when we talk about IPO, for a 400, 500 crore kind of IPO, the cost can range anything from 7 to 10 or 11%, depending on the market situation, how much marketing is required, what kind of valuation you are taking. So based on this, the costing can change. So the cost for an IPO is always higher. Servicing of equity capital is also costly. As I told you that first the corporate tax has to be paid on profits and then investor also pays tax on the dividend. So that's a double taxation. And above all, whatever you do, you have to deliver on the promises. Sooner or later, investor will ask that why the promises have not been completed. So there can be delays. There can be certain off track from what you have initially planned. But ultimately, you should reach towards, and all the steps taken should converge towards the final goal. That is what investors always like to have. Now, what are the key challenges in documentation and compliances? These are some of the outlooks and points which I've tried to summarize over here. Uh, is the company eligible to raise funds? What kind of business you are doing? If you're doing just a trading business, you can be doing a trading of 1,000 crore, 2,000 crore, or 5,000 crore. But does the trading business actually attract investors? No. A trading business will never get a valuation in the market. So you have to understand your business. Then what is the scalability of that business? Today you are working with a top line of 500 crore. In how many years you will double your turnover? If it is a service industry, people will be looking at doubling your turnover in 3 years. If it is a manufacturing industry, people would be looking at doubling your turnover in 5 to 6 years. Depending again on the business to business. I'm not saying this is a thumb rule for every business, but depending on business, there will be expectation of each and every investor. Then what is the acceptability of the business in the market? Today, for example, if I say there was a time way back in 2010 or 12, 13, a company which was into a spinning business in textile was not getting a valuation because that was deemed to be a very raw business without any value addition to it. So these are the times when a business may lose flavor of the market. But ultimately, in last 2 years, there have been some companies which are into similar kind of business. They have come out with an IPO. So these are different time, different expectation of the investors and different kind of business models. So acceptability is always a key. Then differentiating factor for the business, how you are different from your competition, what is the edge you carry in terms of competition, and what is the finally growth potential. Coming to the ideal capital structure, do the promoters have adequate capital to comply with the lock-in provision of the promoters? A lock-in provision says that minimum 20% of the post-issue capital held by a promoter should be locked in for 18 months in a main board IPO. Uh, to the extent I remember, in last around 20 years, only one IPO has come which has included the provision of promoter contribution in the IPO because the capital infused by the promoters in the company was within the last 1 year. So there are different ways of doing this structuring, how you are complying with the regulation and how you are giving that confidence to the investor. So that matters. Then what is the capital base of the company? For being a listed company on main board, you need to have minimum 10 crore of paid up capital. Whether you have that capital or not, or is there any bonus or split requirements are required? Then what is the status of convertible instruments outstanding? As per SEBI ICDR, you can file a DRHP with convertible instrument still outstanding, but you cannot file a RHP where the convertible instruments are outstanding. Before filing of RHP, every convertible instrument has to mandatorily convert into equity shares, and only capital which is outstanding should be equity capital. No preference share, no convertible preference share, no convertible debenture, no warrant should be outstanding on that date of RHP. Then, is there any additional promoter contribution required in the IPO? As I said, in last 20 years, only one IPO has come in this manner. Then, whether issuance of bonus shares or split of face value is required before the IPO, this is a consideration to be deliberated based on what kind of issue price is required and what kind of capital you have. Then, what is the issue price at which you are coming with an IPO? A general perception is 100, 200, 300 rupee is a cheaper share and 800,000 or 1200 valued share price is a costly share. But it does not work in that way. This is just the human psychology or the investor psychology where they believe a small value share is cheaper. But ultimately, the valuation is a matrix. It is always calculated based on percentages or ratios. Whatever be the capital base, the ratios will remain same. So you have to appropriately decide that what kind of issue price you want. You want a 100 rupee issue price per share or you want a 500 or 700 rupee price per share. Then you have to engage into the valuation exercise for the company. What are the comparative peer sets? A detailed working on the KPI, key performance indicator parameters have to be done. What are the positives and negatives of the issuer company? What are the valuation multiples assigned? And what is the assessment of fair value? One more thing nowadays for last few years, which is a mandatory requirement, while the board decide the share price band for the IPO opening, the independent directors have to consider a valuation report obtained by an independent valuer to assess whether that valuation is fair or not. So this is a new requirement which is there for last around 2 years or so. So this requirement is not written in black and white in ICDR requirement, but again, you have to comply with this requirement. Then management side, what is the right mix of the board of director? Whether you require one third independent directors on the board with the independent director as chairman, or you require promoter as a chairman and 50% of the board as independent. Second, women director. Do you require an independent women director or do you require a women director from the promoter family? What is the composition of audit committee? Who will be the chairperson of the committee? One thing is for sure, the chairperson of the audit committee should have financial expertise or should be a chartered accountant in terms of qualification. Then assessment of independence of the independent director. You need to appropriately may ensure that the independent directors are independent in all spirits and words. It cannot happen that the promoter is living in flat number 1 and the independent directors are from flat number 3, 5, and 7. That cannot happen. You have to look onto independence in all manners. Then KYC and documentary proofs are required from directors, KMPs, and SMPs. This is again a gray and a challenging area. We will discuss this. Objects of the issue. Why do you want funds? Is it capex? Is it working capital? Is it loan repayment to reduce the cost of the company for on the account of interest payment? It is intangible asset development. Is it marketing expense? Is it general corporate or it is an acquisition funding? It can be any of them. Uh, One thing is for sure, your general corporate purpose cannot exceed 25% of the issue size. This is the capping on the general corporate purpose. It can increase to 35% if you have some unidentified acquisition also as one of the object of the issue. So combined general corporate and unidentified acquisition cannot exceed 35%. After that, applicable regulation and licenses. What all regulations are applicable to the company? Have you obtained each and every license? We talked about the generator TG set approvals. We talked about the standards of weights and measures approval. Again, an example, there can be a company which is having a factory that approval with a specified number of workers who can work in a factory. But are you actually complying with that number? If that approval is for 100 employees, how many employees are employed on your factory floor level? Is that 110 or is that 95? So these kind of deliberations and compliances also have to be checked. Then what are your requirements of filing of reports with different labor laws, whether you have filed all the reports or not? Similarly, a standing order is a document which need to be verified and which need to be updated. Posh policy, the disclosure should be there on the factory premise also. Certain times factories do not have such kind of disclosures given onto their factory premises entrance. Whether you have your signboard on the factory or your office gate properly drafted or not. Is SIN number missing? Is phone number missing? Or GST number is not printed over there. Your name of the company has changed from private limited to limited, but you have not deleted the word private. All these things have to be done. Contract labor is again one of the key area where certain times companies do not have registration or they exceed the limit which is provided in their registration. So contract labor compliances also have to be undertaken. Then comes the insurance. Whether you have adequate insurance cover for all your assets or not is very much material. It cannot happen that you have a assets worth 100 crore, but you are having insurance only for 40, 50 or 70 crore. Your asset should be absolutely 100% covered. Second, what are the kind of insurance claims the company have taken in the past for your fixed assets, for your stock in trade, or for any other kind of insurance policy which the company had taken? Thirdly, what is the employee related insurance which company have taken? Is it their a group medical policy, a personal accidental policy, or any other kind of policy which have been taken for the employee? Certain companies also take keyman insurance for any of their promoter or KMP. So if these kind of policies have been taken, who are the beneficiary of these policies? That also needs to be disclosed. Then comes the business side. On business side, you have to give multiple details in terms of how your business is working. First of all, a detailed note on the business, identifying each and every aspect of the business, segment of the business, then every business process chart have to be created, be it the manufacturing process, be it the assembly process, or be, for example, you are undertaking business with government tender-based process. So how the tendering process works, that also need to be disclosed in a flowchart format. Then you have to come on to the segment revenues, giving what kind of segment or what kind of product gives what revenue and what percentage they constitute to the total sales of the company. Then geographical segment of the revenues. After that, top 10 customer supplier details have to be given and what kind of dependence is there for the company on them. For example, if top 10 customers constitute more than 50% of your revenue of the company, it also becomes a risk factor. You have to incorporate a risk factor for that. If top 10 customers is less than 50%, you have to give the disclosure, but you need not give the risk factor. So it all depends at what kind of business and concentration of the customer suppliers is there. Then comes the strength and strategies. Strength is how your business have evolved till date, and strategies is that how you are planning for a business in future. Strength can be vouched from your historical financials and historical business operations. Strategy cannot be vouched, and that is the reason why regulator is emphasizing that strategies need to be adopted by the board of directors in their meeting after carefully deliberating that what are your growth strategies. You can always say that you are working for a particular product A and you will go for backward integration of the product B. But what kind of backward integration requires investment? What kind of other expansion of the factory is required? What kind of additional teams will be required? So whether board has deliberated these kind of expansions or not. So this is something what have to be absolutely considered by the board. And I would put it very clearly that today the regulators actually go on to the minute book and see that what you have written in the minutes. If you say that it has been discussed in the board, then the discussion has to be there. What kind of questions were raised by the directors? What kind of answers were given to them? All these things should be recorded in black and white. You cannot say that the discussions happened, but discussions have not been recorded. Because if it has not been recorded for the regulator, there were no discussions at all. So we have to be very carefully while doing such kind of draftings. Then infrastructure facilities, what are available, from where you draw your power, how you get your water for your business operations, and what is your CSR policy and compliances for CSR. The HR related data is required and properties owned and taken by the company on lease. All these have to be disclosed. Yes, I'll just go a little quickly about the process of listing. So you appoint the intermediaries. After intermediary appointment, you work on the structuring of the company for the capital structure, for the board of directors, management, business, everything. Then you work on the due diligence, where secretarial, legal, financial due diligence happens, where certain third-party certifications also come. For example, some of the secretarial records are not available because these were very old data or may have been lost into some fire or transit. In such cases, a practicing CS, independent practicing CS has to be engaged, who will do a physical search of ROC, who will do a search on MCA website also, and then will give a certificate that says this search has been completed. Based on the search, we have found 1, 2, 3 documents. We have not found 4, 5, 6 documents. And based on all the data, the minute book of the company, this is particularly the capital structure of the company. For example, if Form 2 are missing from the old company that. So based on the minutes, based on the available document with ROC, it has to be populated. So these kind of certificates are required from practicing CS. Then you have your search report for loans taken by the company, and similarly corporate governance certificate and few more. Similar way, independent chartered accountant also have to give some certificates. Then if it is a manufacturing company, the capacity assessment report is required from a expert engineer. So registered engineer have to give a certificate with regard to the what is the capacity of the plant, at what capacity the plants have operated, so that it can be shown to the investor that what is the gap available and how the company can expand its operations. After that, it comes to the documentation, which is obtain legal due diligence report from the lawyer. The draft offer document have to be prepared, and then you file it with the exchange. Once it is filed with the exchange, there are multiple communications which happen with the exchange. The communications, NSC and BSC, are completely online filing. You upload the in principle application on the to their portal. You will get the queries on the portal only, but the queries have to be replied through the merchant banker, but again uploaded on your portal. The same way SEBI have a portal, but that portal accesses with the merchant banker. So the merchant banker will upload the document, but then the queries of the SEBI will come over the email and these have to be responded accordingly. To be very precise, there are few time limit foundations given by the exchanges and SEBI onto it. For example, the draft red herring prospectus have been approved on 17th. It has to be filed with the exchanges on 17th only. It has to be filed with SEBI on 17th only. You can have some delay because of the paucity of time. Say, for example, your board meeting concluded at 8 or 9 in the evening. You can work overnight or you can file it absolutely next morning at 7 or 8 o'clock. It has to be done immediately so that there is no gap in terms of approval by the board and the filing. The same way, when any query is raised by the exchange or SEBI, it had to be replied within 5 working days that the tax which exchanges and SEBI have given. So you have to be always on your toes in terms of collating the information and sharing it with the intermediaries in the IPO process so that all these replies can be absolutely given within the time. Then comes the creation of the marketing strategy, meeting the investors, how you engage the press, brokers, you have to appoint the PR agency. After that, you go for the filing. Prior to issue opening, you file your RHP with the ROC. With ROC, it is an auto approval under GNL form. There is no separate certificate required from the ROC for registration of RHP or the registration of prospectus. The board has to finalize the issue price based on the independent valuation report. Then the statutory advertisement have to be given, and parallelly there have to be an agreement with all the intermediaries involved in the issue. After that, the issue closure happens. Post assessment of what kind of demand have been received, what kind of applications have been received. You complete the allotment process. You complete the lock-in and the demat credit lock-in for the promoters and demat credit for the shares allotted, and you get the final listing and trading approval. After listing, you have to do few compliances, market making if it is an SME IPO, routing listing compliances have to be done, and FIRC or FCGPR filing is required to be completed with RBI. If it is a fresh offering, then you will be filing FCGPR. If there is a OFS, offer for sale, then FCTRS form is also required to be filed with RBI. Now, how the application comes in the issue and how the entire process works, because ultimately, when an investor complaint comes, say for example, I have not received the share, my amount has not been unblocked into ADBA. So you should know that how the process runs so that you are able to identify where the non-compliance lies. So to just go through the process, all investors applying in public issue have to use application supported by a blocked amount mechanism, which is called as ASBA. Now, investors intending to subscribe will fill up the form and go to a self-certified syndicate bank. The bank will bid the amount and also block the amount. After accepting form, they will upload the bid with the stock exchange system. Otherwise, you can go to a syndicate member or a stock broker. The stock broker will then approach bank, get the fund block, and then the stock broker will upload the application. Now there is one more channel which is sort of a three-in-one online trading account. So you can use your mobile app or a net application for putting your application through any of your stock broker channel. Then after the accepting the applications forms, the intermediate shall capture the information and upload details in electronic bidding system. Exchange and depositors will do a parallel validation of the DPID, client ID, and PAN number for the application which has been bidded. If there is an error, it will be immediately reflected to the broker or the bank who has bidded the application. It can be modified and then corrected. And investors can view the status of the application on exchange website also. And after closure of the issue, it will be available on the RTA website also, where they can just put in the application number or PAN number and get the details. Now, mode of applications, it is online ASBA, which generally goes through three-in-one account. For example, you have an account in HDFC. So HDFC is a DP also, HDFC is a securities is a stockbroker also, and HDFC Bank has the banking also. This is called three-in-one account. So you can bid through that account also. You can use the bank APA channel also. For example, you can log into your net banking. Into net banking, you will get an option for bidding into an IPO, and you can block the funds and bid from there also. And third is syndicate APA, which generally goes for non-retail and non-individual applications. Then physical applications are in the manner of either bank as the normal application which investor will give and submit in the bank. And second is syndicate as the where the application will be given to the broker, and then broker will go to the bank, block amount, and broker will upload the application. So this is again just rough presentation. In terms of investor, they give the application to broker intermediary, and broker gives it to bank for blocking. After that, broker upload it to the exchange. Otherwise, the investor will give it directly to the ADBA bank or UPI where blocking will happen. Then the bid will be uploaded, and then the file will go to the exchange or after closure of the issue to the RTA for finalization of allotment. Now, once this file is received by the registrar after the issue closure, then RTA works on that file. They identify that where the applications are valid, where the applications are not valid or have to be rejected. Based on that, they create the basis of allotment, submit it with the exchange, and exchange approve that basis of allotment. Once this allotment is approved, then the company will pass a resolution for allotment. It can be in a physical meeting or through resolution by circulation. Then the registrar will initiate the corporate action for demat credit. It will also give instruction to the bank for transfer of funds in the public issue account. Bank will, based on this instruction, bank will act on two things. One, the allotted amount they will transfer to the public issue account of the issuer company. Second, the non-allotted or refund amount. The bank will unblock that amount in the account of the investor. After that, the company will apply for listing and the trading commences on the listing date. The post-issue activity. T is the closure day. From the closure day till the listing, it is a T plus 3 activity. But actually, this entire activity gets completed in T plus 1.5 days. On trading on the day of closure, these are the few activities which have to be completed. Then on T plus 1 day, the finalization of rejection have to be done. The basis of allotment has to be finalized and approval have to be given by the exchange. On T plus 2 day, the fund transfer and the release of excess application money will happen. Demat credit will happen and the allotment will be completed. Again, there are certain specified timelines issued by SEBI in their circular for completion of each of the activities. And by evening, you will have your final trading approval. And next on T plus 3 day, your trading will commence. Now, documentation for the public issue. When we talk about the intermediaries broadly, there are multiple intermediaries which are involved. Book running lead manager, syndicate member, underwriter. These three are the key intermediaries who get involved into due diligence, marketing, and fundraising activity. Then come the legal advisor who do the legal due diligence and work in coordination with the BRNM. Registrar to the issue have a separate role assigned to them in terms of handling the entire shareholders related process and the allotment process. Coming to the right, monitoring agency. If you issued more than 100 crore, you need a mandatory monitoring agency which will monitor the utilization of funds by the company post IPO. Then escrow and sponsor banks and SCSB. These two are the kind of bankers which get involved in the IPO process, and the applications and the account for holding the funds will be with these banks. Then printer and advertising agency. Printer function is getting reduced day by day because most of the applications have now become online. So printer work have reduced a lot and the costing related to printers have also reduced a lot. And advertising agency is required because they draft the entire public issue advertisement, interaction with the various media houses, release of the advertisements, arranging for the road show, the press meet, broker meet, all these things are done by the advertising agency. Now, other two independent certifications which are required, which are at the bottom of the screen. One is a certification from practicing company secretary, another is a certification from auditor or independent chartered accountant. So these certifications are required equally important in the entire diligence process because these certificates form the one of the basis of the due diligence, completion of due diligence by the merchant bank and lawyer. Secondly, these certificates copies are also submitted with the stock exchange or SEBI as and when required during the entire process. Like the indicative sketch and a skeleton of an IPO document, what all is covered in the IPO document. So these are broader heads. We go with the definition, covenant, forward-looking statement, then summary of the offer document, which have now been removed. Then we talk about risk factors involved with the business. Then what is the offer, summary of the restated financial statement, general information which covers the intermediary details. Then comes the capital structure, where the entire evolution of the capital structure is given, entire buildup of the promoter shareholding is given, all disclosures related to the lock-in of the promoter's contribution is given, ESOP related disclosures are given, and certain normal and routine disclosures. Uh, then you have objects of the issue. Another important chapter is basis for offer price. Then industry is generally given by a third party independent agency, business, and so on. All other chapters are over there. The more critical chapters, if I talk from different perspectives, the exchange or SEBI, they review the entire document, but generally they tend to focus more onto the business, the objects, the your risk factors, management discussion and analysis, because this gives the comprehensive picture of how the company is operating. All other sections will be reviewed, but this including the financial statement, this gives the comprehensive picture. When we talk about the investors, they focus more on management discussion and analysis, restated financial statement, the business model, and the objects of the issue. Institutional investors also focus on risk factor, which is not a core focus for retail or HNI investor because they generally try to put investment based on the institution demand only. So different set of intermediaries or different set of sections involved in the IPO process, they look onto different sections in a different manner altogether. For documentation, when you work for the IPO of a company, what all you need to create. When we talk about secretarial records, you need to have resolutions and meetings for requisite approvals. You need to have in place memorandum and articles of association. Certain clauses in the articles is required as per the listed company, so those provisions have to be incorporated. Then capital structure of the company, all documents, whether it is PAT 345 or Form 2 relating to the old Companies Act, the special resolution filed under Form 23 or MGT 14 form, then authorized share capital disclosure under SH7 or Form 5. Then similarly, we talk about the transfer registers if the shares were held in physical form and the detail from the RTA whenever the shares were converted into demat form. All these things have to be collated at one place. Then key industry regulations, what are the applicable laws on your company? All those laws have to be identified. Under these laws, whether you have taken all registrations or not have to be identified. Then history and other corporate matters, how your history has evolved. When was the company incorporated? What are the changes in the registered office since incorporation? What are the milestones you have achieved? What are the changes in the memorandum you have undertaken? What are the subsidiaries, associate companies you have? Uh, Maybe any shareholders agreement have been entered. Details of those shareholders agreement have to be given. Any kind of JV entered have to be disclosed. So all these things comes under history. Then management of the company broadly covers your directors, the composition of the board, the KMPs and SMPs, their shareholding in the company, their remuneration, and the organization structure. Promoter and promoter group and the group company, we have discussed that already. When it comes to financials, you have to get to the restated financial statement finalized by the CFO and the auditors. Based on this restated financial statement, management discussion and analysis of financial conditions and results of operations have to be completed. This MDA contains a comparative analysis of last 3 years financials, that how year on year and why year on year the numbers have changed. What were the reasons for such changes? If your profit have increased, reduced, so what were the reasons onto that? Whether there was any efficiency in operations, or was there any additional cost which was levied on the company which impacted the bottom line? Then financial indebtedness, all loans availed by the company, the terms of all such loans availed by the company. If such loan contains a condition that a prior NOC is required for change in the capital structure or change in promoter holding, then that NOC have to be obtained from each and every lender. Uh, there are certain agreements of borrowings in form of equipment funding. Equipment funding will not contain such condition of NOC, but a working capital loan or term loan will definitely contain such condition. So it has to be ensured that any such condition which is there in the loan agreement is complied with. Then a statement of possible tax benefits, it also comes from the auditors, that what are the benefits available to the company and to the shareholders. After that, business related, entire business overview and objects of the issue related documentation have to be compiled. Then when we talk about legal, all kind of litigation, civil, criminal, adjudication, arbitration or consumer court, every litigation have to be disclosed. The risk factor have to be given for that, and also risk factors have to be given for multiple other objectives. Then government and statutory approvals, whether all certificate registrations are in place, whether all filings and reportings required under each of the regulatory approval is being done on time or not. Then agreement with the intermediary, be it market maker in SME, underwriter, banker to the issue, merchant banker, or your syndicate member, monitoring agency agreement. If you are going for offer for sale, there have to be an escrow arrangement for OFS shares also. So for that, there is a separate escrow agreement. So all these agreements have to be reviewed. These agreements are pretty standard if I talk about the industry, but ultimately, as a owner of the compliance function of the company, you have to review each and every agreement to understand the nitty-gritties. What kind of caveats have been given in the agreement? What are the indemnities? What are the reps and warranties given in the agreement? All these things have to be reviewed thoroughly. Then comes the certification, which are non-mandatory, predominantly given by the practicing CS. It is capital builder, management structure, compliance with corporate governance. It can be financial indebtedness certificate or your search report from ROC. All these certificates are required. Now, if we come to the specifics, when we talk about license, all applicable registration licenses, clean and scanned copy of these registrations are required. Ensure don't take a photo from your handheld phone. Put up into a proper scanner. Scan and keep a PDF or your JPG file. Uh, then all IPR related documents should be available. All registered IPR certificates should be available. All applied for IPR since application till date, whatever communication have happened, copies of all those communications have to be retained. Then whether the registrations have been renewed on a timely manner or not. And the smallest of the registration like shops and establishment, professional tax, labor welfare fund, in Bombay BMC registration, all those things have to be complied with. When it comes to business, be updated with the business. You should know that what is happening in the business. Because if you know what is happening in the business, then only you can tell that whether any particular law is complied with or not. So you have to be up to date in terms of what all operations are being carried. Then NOC from the top 10 customers or suppliers is required because their name will be disclosed in the offer document. Then what are the brands owned by the company, their IPRs, what are the conflict of interest in terms of promoter carrying on similar business into other companies, what is the order book of the company in support, all the purchase orders have to be provided. Then what are the business strategies? It has to be formulated and approved by the board. Employee related data, which division, how many employees are working, which factory, how many employees are working, in corporate office, what are the number of employees working, Then division marketing wise, production wise, compliance and finance side, or you talk about IT or HR. So every segregation has to be given. Again, the segregation can change from industry to industry or company to company. There is no thumb rule to it. Thereafter, a property title or lease related document for all the immovable properties and identification of peer set and KPIs. Objects of the issue, there is a requirement of necessary approval from audit committee or board. The agenda should be detailed. It should contain all explanation that why fund is required for such proposed object. The resolution should be detailed, and every discussion which is undertaken by the committee or the board should be put into black and white in the minutes. Then ensure fulfillment of requirement of third party professional certificate. For example, if you are repaying a loan, then you need a certificate from a chartered accountant stating that the loan was taken for X purpose and have been utilized for X purpose only. Then fund deployment for the IPO. If your object is 500 crore and out of your internal accruals, you have already infused 50 crore into that object. So that fund deployment certificate will be required. Now, if you want amount loan for working capital, so that whether the projections and working capital have been assessed by the statutory auditor, independent chartered accountant or not, certificate will be required for that also. Once we come to capex, if you're doing an expenditure on building up your plant, so do you have the quotations? Are the quotations valid for that on that particular date? Nowadays, regulator is also asking that whether you have taken the alternate quotation or not to ensure that the public shareholders are getting the best out of the available quotations. Uh, Another point which has recently come up is that vendor regular supplier for the company or this is a new vendor? And has a vendor due diligence been done or not? Because in some of the historical cases, the regulator have seen that vendor has given a quotation of for 10 or 15 crore of delivery. On the other hand, their annual sales in the previous financial year was just 5, 10 or 15 lakh rupees. So the obvious question raised was that how a company doing a 15 crore top line will give a quotation for 15 crore and supply the material also. So this vendor due diligence has also become important. In some of the cases, the vendor has given a quotation with the GST number. The GST number was for service business, but the quotation was given for supply of product. So service business vendor registered with GST cannot supply a product. They need to get their category amended. So these kind of diligence have to be ensured before taking the quotation and before submitting them with the board. Then status of present ongoing capex, how much have already been done. So these are the documents related to objects of the issue. After that, litigations. Litigations relating to the promoter and group companies which impact the company. Then litigations relating to the directors, litigations of SMP and KMP, litigations of the company, subsidiary or holding company, for all these litigation, the entire chain of documents is required. That is from the date of filing of the petition till the last hearing order. Everything is required in a proper documented format. Second, these litigations are not just filed against, these are against these entities and these are filed by these entities also. So both side litigations have to be covered. And when we talk about litigation, it is not absolutely litigation only. If you have received a show cause notice, if you have received a consumer complaint in terms of a product, a notice has been given out by consumer court, you have entered into arbitration proceedings. So all these details have to be disclosed. After that, it is the prerogative of the merchant bank and the lawyers whether that has to be disclosed or not. From your end, you should be ready with each and everything. Coming to some of the key aspects, one is data for the promoter, directors, and KMP, SMP. ID and address proof are required. PAN, Aadhaar, passport, voter ID, driving license, bank statements. Then the challenge what comes is there is a mismatch in the name, mismatch in the father's name, mismatch in the address. All these have to be rectified upfront. List of relatives. Complete list of relatives is required, including parent, spouse, sibling, children. Challenge comes in getting data from in-laws or extended family where the relatives are not on speaking terms. There may be two brothers, one brother company is coming out with an IPO, but the brother is not on talking terms with another. How to resolve that problem has to be taken care of upfront. Then come the litigations of the promoters, all kind of litigations as we discussed, taxation demands against the promoter. So you have to get into login of each and every promoter group. You have to take a screenshot from income tax portal, traces GST or any other applicable law, whether there is any outstanding demand. If that demand can be cleared off, please pay it off and clear it off. If there is an appeal file, provide the document for the appeal so that all the disclosures go properly. Then last is the education and experience certificates. This is one of the most challenging area. A person who is running his business for last 30-35 years will never keep his qualification certificate intact. So the challenge comes here that how you get that qualification certificate and how you ensure that the disclosure is absolutely correct. Second, someone has worked for over say 25 or 30 years as a KMP or SMP or as an employee. And now today, if I ask him that, please give me your appointment letter for the first employment, which was 30 years before, he may not be having that. So this is again a challenge that how do I collate that education and qualification proof? Because if in SEBI, in IPO document, we are writing that Mr. ABC has an experience of 25 years, there had to be absolutely backing documents available which says that when he joined an organization, when he resigned, and that period is totaling to 25 or not. The same goes with the promoter also, the same goes with the directors also. So this is the most challenging area in terms of documentation, and to our understanding, it generally takes 15 to 30 days for any company to complete this particular exercise, and topped up with the relative details which we discussed in the first row. Data required for capital structuring, you need all ROC form, copies of resolutions, valuation reports, separate bank account statements, a statement of the promoters also evidencing that the money has gone from the allottee account, representing that money has gone from their account. Then which category of allottee the allotment was made, promoter, non-promoter, P investor, employee under ESOPs, etc. Then what is the buildup of the promoter holding, how the promoter holding have come to shape till date, what is the eligible promoter contribution, and then for ESOP there are certain defined disclosures which have to be given in the offer document. Promoter contribution, we have I will use this word very frequently in this presentation. So promoter contribution is what? Uh, at least 20% of the post-issue capital should have to be locked in for 18 months. Uh, this, if I come to this slide, so minimum 20% of post-issue capital have to be locked in for 18 months. If major of the portion of IPO proceeds is going for capex, this period instead of 18 will be 36 months. Remaining promoter holding and the public holding will be logged in for 6 months. And again, if it is going for capital expenditure, this period will be 12 months, not 18 months. That's an error. So it will be logged in for 12 months. So this is the promoter contribution. Now, what are the securities which are not eligible? Anything which was acquired in the last 3 years by way of non-cash consideration or capitalization of intangible asset, or any bonus issued out of revaluation reserves. These are not eligible for lock-in as promoter contribution. Then securities acquired by AIF, VC, scheduled commercial bank, public financial institution, insurance companies, this in the last 1 year is not eligible. Anything which is pledged with a creditor is not eligible. However, if anything which was raised before 1 year prior to the filing of the offer document, then those shares will be eligible for lock-in. Uh, Further, say for example, before filing of DRHP, 2 months before or 3 months filing of DRHP, the allotment was made to promoter 100 rupees, but the IPO is finally coming at 110 rupees. So if promoter agreed to pay differential 10 rupee per share on that allotment to the company, this allotment will also become eligible. So these are certain caveats which are given under the regulations. Then there is one more interesting concept of KPI which has been introduced over last 3, 4, 5 years. So where you have to give your key performance indicators metric for last 3 years, and also give it comparative with your peer set. So basically for KPIs, you have to work in a particular manner where you identify, I'm talking from right hand top, you identify and select the key performance indicator for the issuer and also names of the competitor. Then you have an internal deliberation and discussion with the management to finalize these. After that, there is an independent certification by a chartered accountant on the same KPIs. This independent certification and the rationale for identification of KPI and peer set is then placed before the board or the audit committee. The audit committee approves that. It is updated again at the time of filing of RHP. And after IPO, it has to be updated till 1 year or till the complete utilization of issue proceed, whichever is later. This is an indicative disclosure of KPIs, how it is given in the IPO document. So in the particular column, there can be total sales, there can be ROI, there can be your EPS or book value, return on net worth, return on capital employed, return on equity, different kind of ratios can come. Then you have to give it into a comparative format for the issuer company and each of the peer set. Uh, then these are few disclosures which are have been carved out for the business purpose, that how the disclosures are given for the business. This is one sample from Bikaji Ports International Limited IPO document where they have given their product-wise bifurcation. Then they have given also bifurcation for impulse purchase or family purchase. And then there is a bifurcation in the KPI side where they have given the volume also. Similar way, you can always give the data based on the geographical sales also, that which one, two, three, four state constitute the majority sales of your company. Coming to a similar, different company, Ether Energy. What they have given is a different complete set of KPIs and the disclosure in the offer document. So, and third is coming from this is JW, not Ether. So these three companies have disclosed just to give you an indication that how each of the company is giving a different set of parameters. So depending on your industry and business, you have to carve out the disclosures of KPI and the business related disclosure, which absolutely highlights your company's performance, which showcase that how your company has grown, what are the concerns and the problem areas, and how the management is resolving those problem areas. So this you can do only when you have a larger access and understanding of the business model, and then you can work on these numbers also. Now, just to give again to an indication to you that what kind of capital restructuring companies have done before the IPO. The first one is from Zomato, where they have done a bonus allotment of 6,699 shares for every one equity share held before the IPO to expand their capital base. Second is from Azad Engineering, where they have done a split also and a bonus also. Now, why this is done? So these are few reasons why the capital structuring of such kind is done. Certain unlisted companies have a small capital base and high net worth. So to create an equilibrium capital, they do a bonus. Then a split of face value from 10 to 5 reduces the prices in half. But that does not mean that the valuation of the company will change. This is again the investor psychology where we are talking about that 100 rupee share is a cheaper share and a 500 rupee share is a costly share. But it does not work in that way into finances. Ultimately, you are valuing your returns on percentage basis. So this is the psychological advantage which you get by doing a bonus and a split. You reduce the price of the share. Then what is the minimum paid up capital required post IPO? So to achieve 10 crore of capital, you can always do bonus. Then positioning of the value or capital of the company with peer set. So if your peer set is having a paid up capital of say 50 crore at a top line of 1000 crore, and similarly at a top line of 1000 crore, you are having a capital of 20 crore. People may not see that capital, but they will see the price difference. So for that purpose also to come to the parallel understanding, you may increase your capital base to 50 crore. So this is also one of the reasons why companies do that. Then pre-IPO capital raise is undertaking generally to get some capital into the company. Pre-IPO allotment is also done for creating a valuation reference of benchmarking, because some of the IPO bound companies have never raised capital in the past other than the promoter fund. So there is no independent valuation assessment which have been undertaken. So to create that benchmark and to give a reference benchmarking to the investor, that pre-IPO allotment is being done. Allotment to the employees is also done in certain cases to make employees participate in the growth of the company. And certain places, the ESOP schemes are implemented to motivate and retain employees for longer term. Now, what are the opportunities for CS to act as a catalyst in this IPO process? As a CS, I would say you have done all these things while you have completed your course. You have worked on balance sheets also, you have worked with management accounting and ratios also, you have worked with business processes, MIS also, and you have gone through the labor laws and corporate laws also. So you have knowledge of everything. The only thing required is you have to just put together all this knowledge. Direct and indirect tax, financial management, financial statement, accounting and auditing, business management, and corporate securities law and other legal compliances. These are the core areas on which you have to keep your complete control. Uh, Anything changes in any of these functions, you should be aware of the change so that you can take decision at a macro level when you are going for an IPO. What should be you prepared for? Educate the board, KMP, SMP on routine basis for the significance of listing, process, compliances. Uh, in broader tone, if I would say, what are the do's and don'ts for them? Then pre-IPO structuring by way of merger, consolidation of business, capital restructuring, bridging any gap for non-compliances, documentation for numerous policies required under Companies Act, SEBI LODR, PIT regulation, POSH, or any other policy required, say for example, appointment letter of an independent director, that also comes into documentation. Agreement with the intermediaries in the IPO, that also comes into the documentation. After that, creating ethical wall, Chinese wall or firewall, whatever we say, between core functions and other operating functions to manage flow of information of insider information. Then drafting and vetting of agreements with intermediaries, resolutions required for the IPO, alteration of articles and memorandum, pre-IPO placement documents, shareholders agreement, ESOP, and reply to regulatory queries. And when we talk about large size IPO, generally they have a position called IPO manager. IPO manager is that one central person in the organization who communicates with all departments in the company and which also communicates with all external intermediaries. So that role becomes very crucial and critical in the success of the entire process. So being a CS and being having knowledge of the entire regulatory framework, financials and other aspects, you are in an apt position to take control of this position also. To summarize what regulator wants, full disclosure to prospective investors, no mincing around the words. You disclose whatever is there. There is a criminal case, there is a murder charge, there is a FEMA non-compliance, there is a SEBI penalty in the part. Disclose everything. Let investor take a call whether they want to invest into the company or not. What your role demands? Your role demands a strive for making management dependent on your qualities and deliverables, plus an active engagement during the IPO and post IPO with the top management and the external parties and the stakeholders. And what post IPO? You have to ensure compliance and disclosures and investor relations so that you remain a zero non-compliant company. Non-compliant company, they are absolutely all compliances in place, properly complied with, no bad name or tag goes onto your profile or the company management or the independent director, because everyone will value the services provided by a company secretary on the same basis. If there is a default, the independent directors will always lose confidence on the professional because that default had happened in the past. So you have to be always on the toes and complete the compliances. So that's it from my side uh, about the IPO process. The topic is very elaborative, but this is what I tried to summarize in this presentation. I think we can take the questions now if there are any.
Yes, sir, there are few queries. I'll just ask some of them. And suppose question is, what are the key areas that a fresher CS should take care of while handling IPO?
So there are two kind of roles which can be there. One is into practice and one is into employment. For employment, there are little challenges because regulator nowadays say that the person who is coming as a compliance officer of a listed company should have some prior experience. The training does not count as an experience. So first of all, if you have to go into a corporate role, you have to work with a already listed company, uh, learn through that entire process, and then if you find suitable, move to a different job and take up higher responsibilities. When we talk about a practicing CS as a fresher, uh, it takes a lot of time to get the confidence of the client developed on you because you are fresh into the profession. So during such kind of processes, I would say you have to ensure that you are absolutely thorough with the compliances, the advisory which you are giving. Try to collaborate with an experienced professional into such kind of business for initial period. Maybe that collaboration can always work for a longer tenure also. It works as a synergy and benefit for both the professionals. But you can, this way you can try to gain the confidence of the client also that they are senior professionals who are associated with your firm, and accordingly you are giving your advice.
So, what are the recent SEBI guidelines on identification of promoter and promoter group? And suggest some advisory besides what is specified in SEBI ICDR regulations.
So during the presentation, I gave an example that if Mr. A is the promoter and wife do not hold any share but is still on the board, so wife will be deemed to be a promoter. The same way, if Mr. A is the promoter and wife is not on board but holds more than 10% of the shares of the company, or say for example for that purpose sibling, they hold more than 10%. SEBI and exchange insist to make them as a promoter because the relationship what these two people have is inseparable. Because of that inseparable relationship, these entities or these individual relationships are emphasized to be brought in as promoter. Second, if the promoter is say in the age of 50s or 60s, and the second generation has also come into business, who is on the board of directors, it is always advisable to take them also as the promoter. So it all depends that how big you want to make the promoter group, because the moment you include more and more people in promoter, you have to go on to their respective relationships also in terms of a spouse, parent, children, and siblings. So this will expand the promoter group. And by the way, for each of the promoter group individual, you have to collect their PAN card and Aadhaar card at least, litigation disclosure, and a disclosure that in what all companies they own more than 20%. So this will increase your exercise to a larger extent, and therefore you have to take a decision on it. If something can be avoided, you should avoid. That's my advice.
So, what is the exact nature and extent of personal, civil, and criminal liability of CS compliance officer named in the prospectus for misstatements or omissions?
So misstatement in a prospectus is a serious offense and will attract criminal liabilities and also class action suits. That is the reason why a regulator have become more and more stringent onto the compliances. Secondly, the nature and the quality of businesses are also changing. Uh, like we said, SpaceX has come out with an IPO in US. In India, we are talking about similar kind of businesses getting generated. Like Servam AI, they recently got some equity investment yesterday only from HCL Tech only. Not today, but probably say 3 years, 5 years down the line, they may come out with an IPO. So these kind of businesses are new developing businesses, and the intricacies and the disclosures related to each of the business is different. So as I said, your name as a compliance officer even goes before the promoter on the cover of the offer document. So your responsibility is the highest because regulator believe that you are a compliance officer and you have ensured that all compliances are in place. So the authority and the name comes with a responsibility also. You have to accordingly manage with that.
Sir, on what basis the lot size is decided, and is there any mathematical formula for that?
In mainboard IPO, there is no lot size. That is just one share in the lot size. The minimum application size has to be between 12 to 15, 10 to 15,000 rupees.
So, do the company require to refile the FS with MC once it is restated?
No,
Okay. So, we end up with the question, sir. Thank you for your
thank you.
insightful session and the knowledge you have shared. It's really valuable, and your efforts which you have taken in the presentations. Thank you for the session, sir.
Thank you to you and all the members who have attended this. Thanks a lot.
Thank you, all the participants, for joining us. Thank you.